Over the last decade, gold has closed higher in January nearly 70% of the time. To most retail traders, this seems like a random streak. They treat the gold market as a purely chaotic environment, reacting only when a headline about a global crisis flashes across the screen. But buying gold simply because the calendar says January is a dangerous simplification. Without looking at the mechanics beneath the surface, a seasonal trend is often interrupted by contrary price action that can wipe out a position in hours. Successfully trading these cycles in 2025 requires a more rigorous approach, one that layers cultural buying habits with broader economic shifts and specific technical filters. Moving from speculative guesses to consistent execution means treating the calendar as just one of 3 necessary confirmation points. We start by identifying the recurring windows of global demand. These patterns aren't coincidences. They are the result of specific institutional and cultural behaviors that repeat every year. In January, the primary driver is institutional rebalancing. After a strong year in the stock market, fund managers often find themselves overextended in equities and underallocated in defensive assets, leading to a massive inflow of capital back into gold. This institutional bid is joined by a spike in physical demand from China. Ahead of the Lunar New Year, the world's largest gold consumer begins aggressive purchasing, creating a physical pull on global spot prices throughout the first quarter. However, this momentum often stalls in March and April. As physical demand from the East enters a lull and Western investors begin liquidating assets to cover tax liabilities, the market enters a period of lower liquidity and weaker performance. The cycle returns in the fourth quarter, driven by the Indian wedding season and the festival of Diwali. This concentrated physical demand from the world's largest physical market creates a price floor, often referred to as the love trade. While these historical patterns provide a reliable baseline for when demand should enter the market, they cannot dictate a trade on their own. The second layer of the strategy focuses on the broader economic environment, which can either amplify a seasonal trend or completely negate it. This chart shows the primary fundamental relationship for XAU USD, its inverse correlation with US 10-year real yields. Because gold pays no interest, its value typically drops when the real return on cash and bonds rises. In 2025, the Federal Reserve's pivot toward interest rate cuts acts as a force multiplier. As the Fed lowers rates, real yields soften, removing the primary headwind for gold and allowing its seasonal rallies to become more aggressive. But we must also watch for friction. If the US dollar index is surging or an unexpected geopolitical event occurs, these macro shifts will override any seasonal expectations. These economic factors determine if the underlying conditions actually support the demand we see on the calendar. The final layer is the technical confirmation, which provides the precise rules for timing an entry. This candlestick chart shows a common pitfall. Even during a strong seasonal window, you should never execute a long position if the price is trading below the 200-day moving average. Being below this line suggests the bearish trend is too strong for a seasonal bounce to take hold. Technical rules are also vital during the low liquidity summer months. In August, with many institutional traders away, price action can become erratic, leading to sharp stop hunts that can trigger exits on poorly placed trades. To manage this, we use the monthly average true range, or ATR, to calculate volatility. By basing stop losses on the ATR rather than a fixed dollar amount, we can account for wider price swings without being prematurely forced out of the market. These technical filters act as a safeguard, ensuring that the trade only proceeds when the price action confirms what the seasonality and macro data suggest. By aligning these 3 factors, seasonal demand windows, favorable real yields, and technical confirmation, we find the highest probability setups for the year. Professional trading isn't about having a crystal ball. It is the practice of stacking these measurable variables in your favor before ever committing capital to a position. You can track the next central bank decisions and interest rate shifts using the FXNX economic calendar. To backtest these monthly cycles risk-free, you can open a demo account on the NX1 platform and analyze how these 3 layers interact with live price action. Applying this framework moves your trading from reactive impulses toward a strategy built on the underlying rhythms of the global gold market.